So, Bill, it's been 6 years, 7 years since the crisis. Stock markets are booming, property markets are crashing all records. Are we out of the woods?
I think we made good progress. No, I think we're still in the woods.
We're still in the woods.
Yeah, I think we still. The financial system isn't restored to its natural health. Sovereign economies aren't back to their national economies, and sovereign states aren't back to their level of required health. And some of the big imbalances in terms of trade flows and the like that existed pre-crisis have contributed to the buildup of bubbles that eventually burst. They're still there, and then we've added a few things along the way in terms of money supply, quantitative easing, and the like. So I think we've made great progress. I think the structural reforms are really pretty substantial on all fronts, but we've got a way to go yet.
Now, some people argue that the problem came because banks were too big to fail, interest rates were too low. Now, interest rates are lower than they were, banks are bigger than they were. It seems like we perpetuated the problem, we didn't necessarily resolve it. Is that your sentiment?
I think part of the problem clearly was that banks were too big to fail. That was more part of the cost rather than the driver of the problem itself. Because if you remember in the pre-crisis days, the market didn't discriminate between risky organizations and not risky organizations. Right. So almost by definition, the subsidy the banks were enjoying because they were too big to fail was small. But when it came to picking up the tab, the taxpayers paid a fortune to support banks that were too big to fail. Banks are still too big to fail. Not all banks, but there are still banks that are too big to fail. But I think the regulatory agenda over the past 5 years has been to bit by bit to remove that subsidy by putting bank creditors in the line of fire. And I think by the time we get to this sort of magic 2019 date, which is what the Basel Committee said is the end date of the period of structural transformation, the too big to fail subsidy will be substantially reduced. In particular in this country, in the UK, because in addition to much more stringent capital requirements, the government has taken the recommendations of the Independent Commission on Banking and is forcing the UK banks to separate their retail deposit taker from the rest of their operations. So.
There are some people that say that this feels very much like 2005 or 2006, wall of money, people desperate for yield, going from one country to another, searching for that yield. Is there in your mind the danger of another crisis looming 2-3 years down the road?
I think there's every possibility of bubbles being created, and as soon as there's bubbles, there's the prospect for loss. I think the difference this time is that the financial system, which was very leveraged in the 2005-2006 period, is much less leveraged today. So I think that the opportunity for loss that comes as a result of bubbles deflating, the way, for example, the dot-com bubble deflated in 1999, the amount of money lost was dramatic, but it was equity that was lost, not debt. And because the banking system wasn't exposed to the dot-com crisis in 1999, in the same way they're not exposed to the tech bubbles, if they are bubbles today, the losses are real, but the accelerating effect that it has when it creates a financial crisis, those conditions are not in place today. So of course we could have bubbles, and those bubbles can be painful to work through. Those bubbles could impact sovereign creditworthiness. It's less likely at this point, not unlikely I would say, but less likely to impact the financial system. And as a result, we could have a good old-fashioned credit cycle without having a financial crisis. And experience has shown that the effect on economic growth of a financial crisis, so a crisis which has at its core a weak financial system, are many times greater than the effect of a pure credit crisis.
There is a feeling that low interest rates over 6 years have become very embedded into everything we do, into government balance sheets, corporate balance sheets, and what have you. And that it would be extraordinarily difficult for today, for central banks to raise interest rates meaningfully because everyone would be underwater. Where do you see interest rates in 2 years, 3 years?
I agree with that assessment. The good news is inflation is very low. And inflation really can only be low because there is still some slack in the economy, even if unemployment looks like it's getting back down to some sort of a normal level. And the slack in the economy is people that aren't fully employed. So while inflation is low, and it is structurally low in the US, in Europe, in the UK, the cost of very low interest rates in terms of the riskiness of very low interest rates is not so dramatic. Of course, it does have the effect of transferring wealth from the saving generation to the borrowing generation. But the saving generation, being you and me, and people of more or less our age, lives pretty well off the leverage hog for a long time, so it's okay, in my mind. Then we pay back, but we are paying back.
It's all justified.
Obviously, there are some casualties along the way, which is lamentable. But I think you're right that we can look forward to low rates for a long time. And the big question is, are rates going to go up before or after inflation rears its ugly head? And it's not today's issue, because inflation is nowhere close to rearing its ugly head, arguably. I think that's the case. But at some point in the not too distant future, it will be a real issue.
Looking at the next 2-3 years, UK, Europe, Western world, the world generally, are you an optimist?
Yeah, I'm an optimist. I'm an optimist. I think in particular the UK and the US, took some pain and have shown very good underlying dynamism. Pockets of Europe have as well. The emerging world has it got overextended at a point, but not catastrophically, and that process is unwinding now. So Brazil and Indonesia, South Africa are on the road to recovery from a mini correction, I'd say. China is sort of steady as she goes. The overwhelming caution, I would say, is that the emerging world is still, for the most part, very big savers at a time of their savers and investors, as opposed to consumers. And they need to make that transition. And if they do, that will address some of the underlying capital flow imbalances that have built up for years. But all these things need to happen without an accident along the way. Yeah. And it would be nice if there were no accidents, but I can't say that I'm highly confident that there won't be.
Bill, thank you very much.